So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult.
It's obvious that there's currently a massive global monetary shift happening right now. It seems like there's a sentiment shift away from the US dollar as the world reserve currency. Almost every country is facing problems with either inflation or soaring levels of debt. And while inflation plagues the US and other countries, coming rate hikes could threaten the stability of the banking system and the global economy as a whole. So today we're going to go into some of Ray Dalio's biggest concerns and some concerning data points that you need to know about. I think first we need to start with the delusional markets. Over the last year, the only thing that anyone could talk about is the coming recession, which still hasn't come to fruition. Now, you would think such talk would force people into saving their money and preparing for the worst, but it seems like the absolute opposite has happened. One great example is Apple. Apple has just been the first company to hit $3 trillion in market cap. And you can see that how it's been trading recently over the past year. Obviously, with these recession talks, it was trading the same exact way when we were having quantitative easing, stimulus checks coming our way, and absolutely no worries in the world. And when you take a look at last year versus this year, the year-over-year growth is -2%, and the year-over-year growth for net income is -3%. But yet, it's still trading even better than it was last year. And again, if we take a look at the Apple market value back here in 2020, when we had all of our stimulus checks coming and everything was rising up, didn't matter what you bought, everything was going up in value. This looks like the same exact chart as we're seeing in 2023. However, times are very different because in 2020, we were worried about the pandemic, but we had a lot of money coming into the markets and really nothing else to worry about. Whereas now we have looming recession talks and a lot of national debt coming our way, and yet the market is still trading the same way it was back in the early 2020s. And it's not only Apple that we're talking about. You can look at Nvidia, you can look at the whole NASDAQ 100, you could look at Bitcoin. Literally almost all risk assets have been going up year to date, as you could see here from the start of 2023. They've gone up double digits easily. Nvidia almost topping out at 200% over the last 6 months. However, it looks like reality is starting to catch up as US consumers lose steam, setting the economy up for a sharp slowdown. Now, one of the main reasons that inflation has stayed so high and has been so high for so long is because US consumer spending has stayed high. A lot of people weren't really taking the inflation seriously. They weren't putting money away. As we saw, people were continuing to spend money. And if you continue to spend money, even if prices are high, that keeps inflation high as well, because that just tells businesses that you're willing to pay that amount of money. Now, while consumer spending is coming down, and that should help inflation come down as well, as you can see in this chart, consumer spending and core PCE inflation are pretty closely tied together. As consumer spending goes down, that means people are having less money to actually do stuff with. And one recent bombshell that just came out recently is that an obstacle for a lot of people's bank accounts are going to be that student loan relief. The loan relief plan set out by Joe Biden has been denied by the Supreme Court, which basically means that people are going to have to start paying for their student loans, which they haven't had to in basically the last 2 to 3 years. And while a lot of people have a lot of debt, that's just money that they don't have saved away or money that they haven't budgeted for the last couple of years. And so that's going to really hit people hard in their bank accounts. And another gauge that we really have to look at is initial claims. Obviously, one of the big things the Fed wants to avoid is high unemployment. And basically, when we're looking at unemployment, one of the first gauges to go is initial claims. This is basically when you go into the unemployment and you said, hey, I lost my job and I want to claim it. This is one of the first claims, or one of the kind of like the foreshadowing factors in coming unemployment levels. And as you could see, since basically the start of the year, it has only been trending up, and we actually hit a pretty recent high of 265,000 claims in the last week, basically breaking the last high in the beginning of 2022. And so if this continues to go up, that also means unemployment levels will go up. And if that starts to happen, that's going to really force the Fed to really rethink, can we continue to push interest rates up in order to fight inflation if unemployment is also rising at a very fast pace? Now, on top of the Fed having to raise interest rates and also worrying about unemployment, there's also a really big problem in the U.S. national debt category, and that's we just can't stop adding debt. Over the past month, we obviously had that debt ceiling crisis where we had to lift it. And in just the last 30 days, we've already minted over $1 trillion in new debt issued. Now, on top of the US national debt having effect, here's Dalio talking about the supply and demand issue we're also running into in terms of the US national debt.
We're right at the brink of starting to find out that the amount of selling of government debt collapsed, right? We didn't issue government debt. And now we're going to issue a lot of government debt. And so when we look at the buyers, there appears to be a significant shortage of the buyers for that government debt. But we're now at the brink of being able to see what that supply-demand picture looks like as we go over the next year and two.
Now, you can see that one of the problems that the U.S. is facing is the GDP to debt ratio. As you can see here in the 1980s, as we were paying off the debt from World War II, we were down all the way to 40%. And then obviously since then, we've only continued to rise from the 80s to where we are now. We've risen from 40% to 120%, meaning we have more debt than we actually do GDP. And to put this in simple terms, we are spending more money than we're actually making. And they say over the next 30 years, this percentage should rise all the way up to 180 to 200%. And to make matters worse, when we're talking about inflation, obviously when we talk about it year over year, it doesn't really seem like it's that big of a problem. But since 1913, when the Fed was created, ever since then, we've just had massive amounts of inflation taking buying power away from the US dollar. And you could see it really ramped up over here when we got off the gold standard in 1971. And since then, it's just continued to get worse and worse for our inflation problem. And it's looking like it's only going to continue to get worse and at a much faster rate. Now, finally, another thing that is really pushing Americans to kind of the brink of a breaking point is that you can see that the income inequality is continuing to rise, as the top 1% since the 70s, since we got off the gold standard, has just continued to rise, making it harder for basically the middle and lower class to just survive in the environment that we're at. And that leaves us at some sort of a crossroad where the Fed right now has to raise interest rates in order to fight inflation. But as they continue to raise rates, that continues to make more government debt. And it's hurting a lot of these banks that are being forced to sell out of their bonds and basically sell for losses. Now you can see here in this tweet, it says that the new FDIC data shows that Bank of America faces over $100 billion in bond market paper losses. Obviously, Bank of America is going to say that they're fine and that there's no problem, but if you remember Silicon Valley and First Republic, they collapsed for the same exact reason. And when you look at this chart, this is showing that these are some of the biggest banks with some of the biggest losses. As you could see, Bank of America leads the way with over $109 billion in paper losses, them being the largest. But then you also have JP Morgan at $37 billion, Wells Fargo at $42, and Citi and Morgan Stanley at $34 billion in losses. And these are some of our biggest banks. If these banks go, so does the entire economy. And this is the same exact thing that forced Silicon Valley Bank to sell out, and because people were withdrawing all their money, they eventually became illiquid. And if this starts to happen with these mega banks, then we could see a really big problem rising. Maybe if they don't collapse, but it could offer liquidity issues. Now you can see in this chart that obviously the banks are performing in different ways, and some of the banks are handling in a different way. But if one of these mega banks goes, they're also interconnected with each other. There's a lot of money and liquidity in between a lot of these banks. And if just one of them goes, or one of them really starts to have problems and the Fed or anybody else has to start intervening, it's going to cause a lot of problems in the economy and also the monetary. So nobody knows what's really going to happen in the next 6 months, or really what's going to happen tomorrow. But as we look at the overall horizon and what's happening right now, it really does seem like we've kind of come to the end of the party. In the next 6 months is when we're really going to get these recessionary fears start to play out as we start to rise these rates and more of these banks start to show losses, especially on paper. That's going to force liquidity issues. It's going to make a lot of these markets and risk assets start to tumble. And again, over the longer term, the next 5 to 10 years, it's going to be really interesting to see how the global economy and the U.S. really play out in terms of fighting inflation and the massive debt that they're accumulating. That's everything I have for this video. If you guys enjoyed it, make sure to subscribe.